My name is Fabian Weir, and I'm the broker here at Prefect Realty. So we're just gonna go over a few things of what my responsibility are as your realtor slash broker. What's most important for me is to understand what it is you, the client, is looking for. You may possibly looking to do a buy and hold, looking at a long-term type of return, and maybe Stan probably looking to do buy and flips. So what's important is that I know exactly what you're looking for, so that way I can give you the best return or the best possible choice for the return of whatever your goal is. So we'll be going over the benefits of buying and flipping. We're also going to go over the benefits of the long-term hold, hence why I call it pension from property. Most people aren't fortunate enough to really say have an employment that gives you a pension. Some people are. What I like to tell people is that we could create our own pension, right? And just simple investments, anything, whether it's stocks or anything. I chose to do real estate, but I believe that you could create your own pension if you do it with any type of strategy and some type of discipline over time. You could create a better return 20 years, 30 years from now, where it could be generational wealth and you could be good. So as your realtor, once I find out what it is that you're looking for, my job is to make sure that I comb the market, try to find the best property. So in doing that, I'm gonna do what we call CMIs, and we're just gonna do comps on the properties to make sure that you're buying it at the right rate. And not only that, but if you're doing flips, I'm gonna go back and I'm gonna look at properties to see what they're selling for once you make the rehab and the changes. At that point, you can meet with a contractor. The contractor can give you the numbers. You can see where you fall into place. And also, what's important too in that process to know the type of loan that's important, like in this situation. There's some lending out there. It could be some type of conventional loan, depends on the condition of the property. If the property does need a lot of rehab, you'll be the best guy for you. Some people buy it with a 2 or 3K loan as a first-time home buyer. I believe most people here probably already have a property, so that might not be the best option for them. But if you're doing rehab or something like that, Mr. Staples will go into more details about what it is that they offer at Hartford Community Loan Fund. All right. As far as long-term properties go, if you're doing multifamily, even single family, I can share a personal experience. My first investment property was actually a single family. And when I said that to people, everybody thought I was crazy. Because a lot of times people, when they think about investment properties, they think about 2 families, 3 families, and stuff like that. My thing is, as long as you're getting a return, what's important to me is the profit margin. So if you could get a single family at a good price and the rental rate is reflective in that market where you could get a good return, then to me that's a good purchase. Right? There's a lot of people out there that want to live in single family residence, so that's still a market. But the main reason why I took that approach was simply I didn't have enough money. I mean, there was no crazy strategy behind it. It's just that I didn't have enough money to get the multifamily. And you know, when you're going through most of the conventional lending, they still want the property to be in a certain condition, and with that, you know, the price is a bit higher. So I went the single family route, and to me it worked out well. I rented it for a few years and ended up selling it and still made a return. So it doesn't have to be a multifamily property or anything like that. Anything that you could gain some type of return on, to me that's a good investment. All right. As for this building here, I went the route of a hard money lender for various reasons, and he could delve deeper into that. The main thing is that when I was buying this property, it was vacant, and most of the banks wouldn't give me any loan for it. There was considerable amount of work that needed to be done, but mainly cosmetic. But the big thing was that I didn't have a company for a couple of years where I could show returns on it. There's a lot of red tape in that process. So in that situation, what was important to me was to go with a hard money lender. That was my last option. With that, I got a higher interest rate. I was paying interest only. Got the opportunity to go and refinance it at a better rate and a longer term, basically. So I'll touch on a few of these stuff later, but for now I'm gonna introduce Mr. Staples, and he's gonna go over the stuff that he offers at Hartford Community Fund. just picked up the phone and called you.
Really? I didn't run through any deal structures with you?
Nothing.
No opportunity.
See, but I do with your company from when you guys were on Franklin Avenue a couple
Right.
years ago.
Okay.
Yeah.
So let me tell you first about the loan fund. We've been around now for about 20 years. We started out as the South Hartford Initiative in the south end of Hartford, mostly lending, doing home improvement loans, bathrooms, for people whose homes were upside down back in the I guess it would be the late 80s, early 90s. Anyway, I joined the loan fund back in 2008 as a consultant, and just around then they started changing their focus so that they're not just the south end of Hartford anymore. And they started lending to construction rehab type projects. So our minimum loan size is $50,000. At least 25% of the loan amount we lend must be for renovation of the project. So, as you can probably imagine, around 2008, we're just going into and about to, that deep recession, and a lot of values really collapsed. Back then, people were taking out home equity lines to buy BMWs. And all of that stuff. Oh, you missed it.
Yeah.
Okay.
Yeah, I was a teenager, but I didn't know what was really going on.
A lot. Yeah. Anyway, so we got a lot of people who were upside down who would come and say, "Hey, could you do a refinance for us?" And we couldn't, because we had restricted ourselves to doing. First of all, our projects must have a residential component to them. The loan fund's mission is to provide fair, equitable financing. Started out Hartford's residents, and we still are predominantly lending in Hartford. And as a byproduct of that, we're looking to improve the condition of the housing that we finance in Hartford. At one point, there was some statistical data back in the early 2000s, where more than 60% of Hartford's housing stock was substandard, not in good, modern, up-to-date condition. So part of what we're looking to do as lenders is we're looking for investors who, there are people out there who will, what they call, put lipstick on a pig and turn it around. We're looking for people who are gonna really look to improve the quality of the housing, and then after they invest, maintain their investment, with the upkeep, the property management that goes with it. Hartford, I would say easily 70+% of Hartford's demographics get some form of government assistance, including Section 8, those kinds of things. So the demographics in the greater Hartford area is a challenging demographic for investors, right? You get someone in and they don't pay rent, you take them to housing court, and I've seen it take 6 months to be rid of a tenant, and not only do you lose 6 months worth of rent, but you also have to repair the damage that might have been maliciously done as they were leaving. All right, so this is not for the faint of heart, and that means to if you're doing 1 to 3 family and you're not flipping as an investor, we want to see that you have experience managing the demographic that you're dealing with in Hartford, okay? Because it's not, what I mean by managing, knowing how to identify a good tenant, right? Taking taking that application, checking police records, that kind of a thing. I know Janet and her husband does quite a bit of stuff, so they've seen what is out there, and it can be ugly at times. So it's not all, bells and whistles getting in. And you need to be budgeted and prepared to not just the investment, the down payment money, but you need to have support, and we can work that out. All right, so I just wanted to give you that kind of a prelim. The loan fund, as I've said, will lend to anything residential. Our market area is all of Hartford. I should say our prime market area is all of Hartford, all the towns that are immediately adjacent to Hartford, including 3 towns that you might not think are adjacent because of the river. And that's Glastonbury, East Hartford, and South Windsor. All right, so you'd know Windsor, West Hartford, Bloomfield, Newington, Wethersfield, all touch Hartford. That's our primary market area. We also lend in New Britain and Manchester. Okay? And our board of directors mandates that at least 2/3 of all lending that we do during the course of a year must take place in that what we call our primary lending area, which is those 2 towns, New Britain, Manchester, and the towns surrounding and including Hartford. We can go anywhere else in the state with existing customers and existing investors. Since 2008, 2009, we've deployed over $15 million in loans in our primary market area. I would say, especially coming out of that last recession, we have probably put, as a lending institution, more capital into Hartford, the South End, got most of it, but also in the North End, all over Hartford, we've deployed a lot of rehab capital. Our projects range from customers who were doing mostly single family were flips. I should say, I will start with me. I want to help people create wealth. That gives me pleasure when I'm doing my job, that someone has saved up their down payment and they're coming in and now they are going to start an entrepreneurial initiative and create wealth for themselves and their families. That I really like that. My background for over 30 years now is commercial real estate lending. And I'll just say I started at Phoenix Mutual in the insurance side, worked for Bank Boston and Sovereign Bank, and then now I've been with the Loan Fund. So I'll give you a loan scenario, all right? I see you have the chalkboard.
Yeah.
I can. Let's say you find a property that's selling for $40,000, and the math here is going to add up to 100, so I can give you percentages based on the 100. So the cost of the house is 40. Let's just go with a single family home to be realistic. So it's 40,000 to buy it. Between financing costs, appraisal, legal fees, title work, and such, that's another $10,000. And then you're gonna need to rehab this house, and let's say it's $50,000 worth of renovations that are needed to the house, right? So that total adds up to $100,000. So the acquisition is purchase price 40, financing 10, and then renovations, rehab 50. At the loan fund, at the loan fund, we'll lend up to $80,000 against that scenario. We'll lend up to 80% of the total cost of acquiring, financing, and renovating the project. And how it works is that, so we said the purchase price is 40, right? The equity or the cash is gonna be 20, where we show up at the loan closing, the Hartford Community Loan Fund and you show up with your 20. That 20 goes straight to the purchase price and the seller, and then we finance the rest. So we will finance the second 20 to complete the purchase. We will finance the financing charges, your commitment fees, your closing costs. And then after the closing, we start dispersing the $50,000 for the renovations. To be a customer of the loan fund, you must either be a state licensed general contractor or have one under contract when we close the loan. And he must have given you a construction budget that fits the $50,000 cost estimate and be under contract to deliver that renovation, which includes a certificate of occupancy, once this money is fully expended. We only fund against labor and material in place. 99% of most home improvement contractors, if the roof is 20,000, they're going to want 5,000 to start the job, and then when them reach another point, them get another 5 or 10,000, and then them get the last 5,000 when the roof is finished. That's not how the loan fund finances construction. So most of the time, you will need to get a contractor that is not part of the 99%. Because you'll need a contractor who probably has trade lines with his suppliers, right? So that he knows in 30 days he can get lumber, he can get materials on a kind of a float for 30 days, get it attached to the property or installed in the property, and then within 10 days or 20 days submits his draw request for the work he's done, the labor and the materials he's put on the project. And then we will have an inspector come out, take photographs, confirm that the work is done, and our construction consultant will then approve the draw. We cut the check to both the homeowner and the contractor.
Would he need to be bonded in order for him
No.
to? Okay, all right.
No,
He doesn't have
bonding kind of doesn't really work for
that.
jobs at this small scale.
Okay.
And I mean, bonding doesn't start coming to play until you start talking in the millions.
Okay.
You know, $5, $6, $7 million.
Okay. I wasn't sure because you said that the contractor would have to have enough funds on hand to get more. Because you're right, most contractors, like quarter the job, they say, "Give me 5 for this." Then 60 days you give.
And you know the risk of that, right?
Yeah, but they can run off. Well,
Right,
that and then
right.
sometimes they don't finish. Things become interesting.
So, I mean, we are serious about checking the credit of the contractor, checking his reputation, references, jobs he has done of similar size. With both the investor and us, the lender, are kind of partnered on each project, after closing. So we want to give our customers the best chance to survive. And we've seen some disasters, over time. I tell you, 15 million, I mean, the average loan we do is about $120,000. So that's a lot of projects that we've done over the years. And so we've seen a lot of disasters, a number of disasters. We've seen, mostly good stuff, but so I'll tell you, now that you see how we structure, how we price, our construction risk is generally priced at 8%, and we typically give 12 months to a construction loan. Our customers also get to choose from 2 permanent loan structures after the renovations are done, after they've completed their renovations and leased up their properties. And I'll tell you one thing, what we've seen in Hartford is as soon as the project gets underway, just the fact that the units are going to be newer, our customers tend to get, their units get leased sometimes before the project finish, alright? Just because, as I said, a lot of the housing stock in Hartford is not of the best quality, alright? So, that's one thing out there. So we have a 5-year mini perm that you can flip into once the project is complete. And then we have a 20-year fully amortizing mortgage that is, we co-finance that loan with CHFA. And that loan is priced anywhere from 5 to 6%. The 5-year money is priced anywhere from 6 to 7%. Both loans are amortized on a 240-month amortization schedule. Anything else I can tell you?
What are you looking for as far as, I guess, qualified people, like?
600 credit score. Sorry. Now, I'll tell you one thing, we are not, on our lending program is very different from the conventional mortgage lending programs that are out there. Those programs tend to decide financing based on debt to income and housing expense ratios, okay? Our projects are structured so that the real estate, the investment real estate is what pays for itself. So what does that mean? If you bring a 3-family into us, we won't lend you more money than the 3-family itself can't repay over the term of the permanent loan. So the cash flow from that 3-family house should be sufficient to pay us back our mortgage fully over a 20-year term.
So,
Okay.
so you're basing that off the rent that you're gonna get from
The tenants.
The tenants.
And we model a typical operating expenses, we model sometimes more, that, like real estate taxes is a given, everybody pays
Right.
that. Insurance, everybody must pay.
Right.
We have certain number provisions for repairs and maintenance. A lot of times our customers for the first couple of years don't have to pay much more than shoveling snow, that kind of thing, but we budget a little bit more. We budget a 5% management fee as an operating expense that most people don't really charge themselves when they're operating their properties. So, but we make sure we have certain base
Right.
expenses in we call it the pro forma income and expense analysis or projection of the project, and the net income must be enough to cover debt service on our loan 1.25 times.
Right. So quick. So, for example, let's say you're like the mortgage company. So if I own a property, and then because the thing what I'm looking at, so if you do this and say I'm the investor or whatever, right? And I know of course you guys got to get paid. So if it's going by if it's going by the profit of the 3-family, now will the investor get a piece of that too? You get what I'm saying? So for instance, I own a 3-family, so I pay my mortgage company, right? They get theirs, and then out of that, there's say $1,000 left. There's $1,000 left once the mortgage is paid from the expenses.
Mhm.
So does that go, cause to me, what would make me wanna invest if everything's going to you, if that makes sense?
No,
It's based off your rents. So if you're
No,
investing,
no,
you
that's
affect
not-
your mortgage.
let me answer this question. The only thing you pay us is the debt service on our mortgage.
Okay. Whatever that percentage is,
The interest rate
right,
and the amortization schedule will tell us what the monthly payment is, right?
okay,
And that's the only thing you're obligated to pay us off our mortgage. We're just a mortgage lender.
okay, and then, so pretty much if there's
If
anything.
there's anything else, that's your business, that's your
Okay,
money.
nah, I was just wondering, okay, got you, long as the three family can cover the debt that I owe you guys, whatever else is left over is, I got it, okay, makes sense.
Quick question. I wrote this down. It says, would you advise it's better to flip? I mean, I'm talking about Hartford. Even in the area, like you watch TV, HGTV, people flip all the time, and it's like the thing that everyone wants to do. But would you say it's better to hold and rent these properties out, or would you say it's more profitable and just makes more sense to just do what you said, purchase and do everything you just set up there, and then 6 months or whatever, you just flip the house, you sell it, and you get whatever money value, increased value from the house, and you just move on to another deal. I mean, what would you advise based on what you see in the market? I know it's a vague question, but
It's not a
It's
vague,
not a big question.
it's a
It's a loaded question.
it's a question with however many people in this room, there would be that number of appropriate answers to that
I see what you're
question.
saying.
It
Okay.
depends on what you are looking for.
Okay.
It depends on where you are as an investor, how mature you are in the process of being an investor. What do I mean by mature? Have you been doing it long enough where you've got your portfolio of discretionary cash so that you are in position to take advantage of other things?
Mm.
All right? If this is the first deal you're doing,
Mm-hmm.
and you're looking to grow your pool of initial investment cash, that's one if, right?
Mm-hmm.
Here's another if. If you're in the market in 2009, 2010, when everything is depressed, right? And there aren't people having seminars like this on how to invest in real estate.
Mm-hmm.
Yeah, I would say find the property, give it a couple of years and flip it,
Mm.
right? Because what we've seen since 2008 is housing in certain neighborhoods in Hartford, the three families were down to $150,000 in good shape,
Mm.
right?
Yeah.
When things were at the bottom.
Yes.
So it depends on where you are in the S curve of an economic recovery
Mm.
for real estate. If you're down here,
And
yeah,
flipping probably doesn't.
flips make a great deal of sense
Okay.
if you're down here to start and 2 years later you end up there.
Then you
Right?
flip
At
it.
that point you wanna try and flip up here,
Mhm.
right?
Mhm.
So that's the general concept behind flips.
Mm.
The other thing with the other type of what we're seeing now is flips are on the decline.
Mm. That's mainly why I asked that question because
Flips are on the decline
Mhm.
because there's so many investors bidding on any property that comes up.
Mm.
So that drives up the price of the project.
Mm.
Income, investing for the cash flow, is another thing, right? And hopefully, even if you do a flip, you can, if you buy down here and you wait until up here, you can get some cash flow.
Right.
While you're waiting for it to-
right?
And the
But-
thing, oh,
Go ahead.
The thing-
Donville is an expert.
The thing with flips versus long term, it's two completely different strategies. Flips have tax consequences also,
Okay.
right?
See, that's what
So-
people don't talk about.
People don't talk about it. If you flip and you make $100,000 profit,
Mm.
15% you have to pay in taxes.
Capital.
The capital gain. There's no going around it.
Well, yes, there is.
There is,
even-
if you really flip into flip, there's no going around because you can't carry that money to another property per se if you're doing volume.
Yeah, I
That's
was
the
gonna
only
ask
other way
that.
to do it.
You,
If you
so
move it
so
to another
you should
property
point
right away.
out that
Yeah,
if
but
you
it has to be done like
reinvest
fast.
your profit in another
Right.
property,
Right, in another
Then you
one.
avoid-
But eventually it's gonna catch up with you.
Okay, because you
Well,
won't.
You can pay Peter, you can delay it but so long
Right.
if you're flipping.
Right. And you also have a timeline to
Yeah.
put that money.
Right.
Right.
yeah,
So-
I have customers, especially a lot guys who are contractors, who are seeing a lot of these projects, who can keep the money
Right,
turning
Right.
over.
right. But for somebody just starting out, you don't wanna be pressured to go make a deal just to carry that money.
Yeah.
Right.
At
To-
that point,
to
I'd rather
avoid
just
the
pay
tax.
the tax.
Right.
Yeah. Okay.
And
And
another
that's
thing,
my point, because you
another
don't
thing
wanna
to-
be pressured to spend the money.
Like a regular person
Yeah.
can do that.
Yes.
You know?
Yeah,
If this
another
is what
thing
you
to
do
do
every
with-
day, then
Right.
I see what you're saying. I
another
get
thing to do with flips and capital gain, try and avoid the sale until like January of the new year. If you're
Right,
flipping
you
up,
have more time.
you can get almost 15, 16 months that way,
So you're saying start if you're gonna sell it, do it start
very early in the tax
in the
year.
year. Okay, I got you.
But most of the time you don't have control over when you wanna sell it. You wanna sell it as soon as possible because
Right.
You
you're carrying costs and the taxes, the utilities,
insurance, all that.
all of
yeah.
that. So the longer you hold on to it,
The more money is coming out of your profit.
And so one more thing to come back to
Mm-hmm.
that example up here. Yes, we'll generally lend you up to 80% of the cost to buy it, finance it, and fix it. But if it's a 3-family, we want a 1.25 times debt service coverage for the net income. So that means you must rent it at high enough rental rate so that whatever the mortgage is, it cannot be less than 1.25. A multiple is a more, right? Which one is it? You multiply the mortgage payment by 1.25 to get to what net income you will need. So some of our loans, and it happens most frequently with the single family home, will get constrained. The size of the loan will also be constrained by the rents that you can get on a single family property. So for 3 families, it's 1.25. For single families, we get down to, I think, as low as 1.05 for debt service coverage. And debt service so who knows
Debt
what debt
service
service
just a-
coverage means? No, all right, so let me just tell you. I'll give,
Is that like a mortgage insurance, like a mortgage?
no.
Okay.
Quick finance lesson. Alright. Every investment income opportunity, be it real estate or business, has income, expenses, and if it's a viable situation, income more than covers expenses, so you have net income. Right? After you subtract
After you pay all
expenses.
your bills.
After you pay the bills, right? Net, in real estate, this is called net operating income, where you take your rents, and then for expenses, you have real estate taxes, insurance, utilities, what else? Whatever else.
So we'll remove all any
Repairs and
yeah,
maintenance,
yeah.
alright? Those total expenses get subtracted from the rents, right? Which leaves you with net operating income. When you start doing commercial real estate, you'll hear them talk about NOI. Alright? NOI is what pays all the sources of capital needed to fund and capitalize a project investment, whether it's real estate or a business. So, and there are only two general sources of capital. There is equity, which is the owner's own personal savings, and debt. All right? Which is what you go borrow from the bank. So the two key sources of capital for any investment opportunity is equity and debt. Equity you get by saving up extra money, and Janet can tell you all the different ways to save up your money, and then so that was the $20,000 in my original example, right? And then now the $80,000 was the debt. Net income should be enough. A good investment will have enough money to pay the mortgage and collect the $1,000 off to the side, or even more, to pay back the owner on his initial $20,000 or $30,000 equity investment. So when I talk about debt service coverage, if a property is throwing off $20,000 a year in net operating income, it can support it can pay $16,000 of that 20 towards a mortgage payment every year. All right, and provide a 1.25 times debt service coverage. So that's money going to the bank, and then the $4,000 goes to the owner of the property, or to the net operating income. All right, so that is what debt service coverage is. The ability of the net income to cover the mortgage payment. And that's the 1.25 times debt service coverage calculation.
So you mentioned earlier that you only need a credit score of 600. What about income? Do you look at income? Do you look at debt? Nothing but the credit score and your savings. That's it?
That's the basic requirement.
Okay.
Now, a customer who brings in, let's say they bring in a 3-family. It's just about fully rented. All they need maybe is to put on a new roof and some, aesthetic enhancements. So the construction project is not a serious, difficult construction project. Then I'm not gonna be concerned that much about things going wrong during the construction, and then that customer having reserves elsewhere to help fix a problem, right? So,
Because it's fully rented already.
because it's already fully rented, there's not much construction risk. So, yes, 600 credit score. Generally you have a job, you're paying your way. That means you're paying your bills, generally speaking.
Right.
You've established a pattern of paying your bills. We're going to talk to you about the project. If the project is a very extensive one, like a gut rehab, 80% rehab of a building, and the project, you and your contractor says, okay, that's going to be $150,000. What that will cause me to do as a lender is that, and I start now saying, if anything goes wrong, how well is this customer going to respond if all they have in the bank account is $5,000? All right? So there's some solutions to that, right? I can do a 20% contingency if the loan size, and the value of the property will support that. But so it's kind of like the question about flips versus investment property. It depends on the actual project. What kind of experience the customer might need, and if they don't have that experience, how we might backstop it with things like additional contingency in the project budget, so that if there are cost overruns or the contractor leave before the project finish, those kinds of construction is
Key.
it's not fun because so many things can go wrong. 9 times out of 10, the contractor and the owner finish the project and then they like one another.
True.
No, you're right.
All right. Now it takes a very mature contractor a lot of times to manage the customer's expectation, and most of the times I would say it's the customer's fault because first of all they're not experienced. This is probably the first, second, or even the third job they're doing, and that's not enough experience. 10 I've found is not enough. 10 projects. And the customer has this idea of what things are going to look like. And then when the project get built, so I'm just,
That's when you need a really good realtor to bring them back to a reality.
well, I don't know if certain situations can be remedied. Reality. So anyway, it's a challenging situation. So Fabian, please forgive me, but what happened this evening was I went home early.
No business cards.
And then my calendar reminded me like 20 minutes
No, that's
beforehand.
all right.
So,
I'm just glad you showed up. That's all right.
so you have my, so I'll write my number.
Yep.
All right. 860-969-3003. Richard. Staples.
We'll see. No? Alright. Straight.
Any other questions?
What was the name of the company?
The Hartford Community Loan Fund. We're on the corner of Garden Street and Ashley Street, above Kent Pizza.
What's your rate like?
8% during the construction term.
And that can
Anywhere-
vary afterward. After the construction's over, that may vary.
Yeah, fixed during the construction term, anywhere between 5 and 7%. Anywhere between 5 and 7% for the mini perm.
All right, perfect. All right. I'll get you. I'll write down that phone number.
Hartford.
The Hartford Community Loan Fund.
You can slide this book over.
Right.
Alright. Thank you, Mr. Staples.
You're
Appreciate it.
welcome.
The beauty of this is that, like I said, there's realtors here, people with experience that's done this. I'm gonna introduce 360 Home Services in a second, but like I said, this gentleman here not only is he is a part owner of this company, but they have a lot of experience in doing home flips and stuff like that. I'm gonna touch upon something that Mr. Staples said earlier, because a lot of times when we think about investment property or people ask me about it, I think everybody believes that you're just gonna get rich overnight, and it really don't work that way. And there's some type of headache that you run into throughout the process. Sometimes it's
Nothing
smooth.
good ever comes easy.
Exactly.
Right.
But
Alright.
thank you.
Where you running to, Richard?
No, I have fire practice.
I just want to put, I've worked with Richard in the past and much better than a traditional bank. Just one example, I've gotten a mortgage with a regular bank and a lot of money flows in and out of my account. Not that I have money in my account, it flows in, it flows
You
out.
have holy for money.
So the regular bank, one time they saw a deposit of $950 and they asked me to write a letter to explain it because that's how they scrutinize your bank statements when you're getting a mortgage. But working with Richard, they're completely different, very easy to work with. The interest rate is a little bit higher, but you're guaranteed to not face those issues and know you're gonna close. So
Thank you.
That's the difference. Thank you, sir.
Bye.
But, what are they? So one of the things that I was going to touch upon that Mr. Staples said earlier, other than the fact that he's giving you a realistic approach to investing, is that, like you said, nothing happens overnight. Nobody get rich overnight. As a matter of fact, sometimes when you're doing rental property, you run into the headaches. But really, the return is slower. But as you build a portfolio, it becomes better. When you get to the point where you got 5 or 10 properties, that's when you really see a true return, and that's when you really kind of earning a pension from your properties. Another thing that he mentioned with the nightmare tenants, I've kind of been through that, but it was towards the end. What you could do is, and they hear these, we use these terms all the time, due diligence. Like realtors like myself, Miss Cindy Robb, Janet Riley, and Mr. Nigel Rodney. What you find is that we have to do our homework on this, right? If you buy a property, you rehab it, or maybe you buy it with a couple vacant units, and you get it ready for renting. What we will do is that we have to do our due diligence when we list that property. So I'm going to ask you, what is your minimum credit score that you're looking for in a tenant? As long as these are non-discriminatory, like we will try to match these criteria. We'll try to do the background checks. We'll do all of that stuff, so that way. And this still doesn't guarantee anything, but it gives you a better shot at having a fit tenant. It's not like before. A lot of people try to take the shortcut, and they just put a for rent outside, and somebody come to them and tell them that, yeah, I make so and so amount of money. Because we're doing income verifications, we're doing all of that stuff just to make sure that you have the right tenant in that property. So that way, you could probably avoid some of the headaches. But like I said, nothing is guaranteed, but we'll do our best in order to alleviate you of that issue. So, all right, so I'm going to introduce Miss Danville Riley, part owner of 360 Home Services. There's some business cards here if you like. Like I said, not only does he have a lot of experience, because they do have a few rentals, they've been in this process, but he could go a little bit deeper, not only in the money side of stuff, but also how to fix the properties.
All right, hello everybody, I'm Donville. My partner Graham is right there. He does most of the day-to-day operation. And Richard touched upon it. I mean, for flipping and whatnot with a contractor, it's all about managing expectations of each other and making sure everybody's on the same page. And a lot of things are going to be out of your control. For example, after we finish a job, it's got to get inspected. You got to get the permit passed, right? So sometimes the inspector, you know, they don't have availability 1-2 weeks. So things like that slow you down all the time. But it's important that you trust the person you're working with, because there's a lot of different ways to go about it. Either it's a 2 or 3K loan, or something where a mortgage company is involved, or it's an investor that is just paying out of pocket with a hard money lender. From a contractor point of view, we prefer working with a bank because we know that the money is guaranteed and whatnot. But with a hard money lender, it's kind of different, where you don't know if they're going to release the next draw based on whatever they don't like. So we prefer 2 or 3K. Not that there's anything wrong with hard money lenders, but we like to know that our income is guaranteed, because most of the time we're fronting the material and labor costs after you get it. So the way it works is, you acquire the property for a 2 or 3K loan. We basically go in, get an estimate. We provide all our information, such as insurance, licenses, and everything else to the customer. And then based on what we estimate, we provide an estimate of the entire project, what it should come to. So we would submit that to the bank. You would be approved for either that amount or less. And then we go from there. So basically that first quote is pretty much the Bible. If it's not on there, we're not doing it, because we don't know if we're getting paid for it. So that's one thing to understand in flips. If you're flipping a house or whatnot and you're going in there, you gotta have a list of everything. We gotta give you a quote, and that's what we go by. Everything else has to be a separate agreement that we work through later on. So that's the gist of the 2 or 3K loan. And stop me and ask questions at any time if you want. What else do you guys want to know from the contractor side? Because I don't want to just ramble.
Like I was mentioning to them earlier, and sometimes we use these acronyms, but like with CMAs and stuff like that, is when we give you those numbers, what we try to do is give you probably like a more of a straight shot of what to expect. When you end up meeting with him and he gives you your numbers, and then we can let you know what the cost or the actual market value of the property is, and what the resale cost is. When you do the numbers with him and you run those numbers, you can see what your potential profit margin is, because the worst thing that could happen, especially if you're doing a buy and flip, is that you put more money in a property that's really not worth
Right.
what you're putting in, and you try to avoid that at any cost.
Right, and that's very important, because based on the number that he gives, and when we talk and your expectation, if you expect hardwood floors that are $5 a square foot, but during the quote I put in $1.50 a square foot, it affects the resale later on. So that's why it's important everybody is on the same page.
And also, I think that's a good topic, because I drag these guys. I have a lot of contractors who want to buy houses and flip them really quick. So I'm always dragging these guys to the buyer, to the houses prior to making an offer, because they have in their head that they'll buy this house for $50,000 and then put $20,000 in it and sell it for $130,000. And it doesn't really work like that, because a rental, to really rent a house and do it properly so that you can sell and make money does cost a lot. So sometimes we have to make sure that, you check these guys out ahead of schedule, so you can make sure that the finance part of it works.
Right. Yeah, because the material costs, it's very important that we agree on what type of materials you want in there up front, because that could make a big difference.
One thing that I'll add in, like I said, due to the experience that they have, they could probably go a little bit deeper into this. Like I said, this is a networking type of event. It's not just us really talking to people just directly. So you could, even after this, you guys can ask questions. We have experienced realtors, like I said, investors, and all in one. So you could always maybe ask questions. But sometimes when people are, let's say, selling properties, they don't understand that it's not really just what the bank loan to you that you're paying back. Sometimes the banks will have origination fees in the beginning, so you're gonna run up in that in the first place. So that's really still coming off of the top, off of the margin that you were looking at. When you sell the property, you're gonna be looking at conveyance fees, which is not conveyance tax, I should say, which is not terrible, 0.75% of what that sale is. So I guess that's not terrible. Where they really hit you with is the capital gains. Like I said, there's ways around it, legal ways. We're not trying to tell you any wrong ways, but one thing you can't do is avoid taxes. Like somebody
Right,
told
and
me,
everything is recorded, so there's no way
Everything.
around it.
like somebody told me when I first asked them about it, and I said, I would do flips, but the capital gains, man, I don't know how I feel about it. And he told me, he said, if you're not paying taxes, you're not making money. He said, hey, it's okay to pay taxes, because when you're paying taxes, that means you're making money. So whatever approach works for you, just expect that IRS is always going to want some piece of it. So you could talk to maybe a financial advisor, which I do have the contact for a financial advisor that could give you your options, whether you want to put it in long-term retirement accounts, and that way you can funnel some of your profits into that, and it will lessen some of the burdens on that. And like they said, sometimes you could roll some of the profit into properties, but eventually you still kind of end up paying out. But like I said, there's nothing that you make money without you not paying taxes. If you're at work, if you're killing overtime, you're paying more taxes. See, but we learned to not even look at the check before the taxes, right? That's just the same with anything. But yeah. So I don't know if you guys have any more questions for Mr. Riley.
Typically, how long does it take for you to complete a project from beginning to end?
All depends on the complexity, and also if everything is funded by the bank, we are motivated to get it done. We are motivated to get paid as quick as possible. The sooner we get in and out, the better it is for us. And I'm just being honest with you. So even if we gotta stay there, work late or whatever, we gotta move to the next thing. So it depends. We just did a house in New Britain, and it took what? We got it in May, and by July it was done. So it all depends. We did 4 furnaces, we did electrical, roof, a bunch of stuff. So it all depends on the complexity and how quick and responsive. Because when you do a 2 or 3K loan, there's also a third party involved, the HUD inspector. So depending on his schedule and all of that, he's got to meet with you, approve everything for you to get paid and whatnot. So it's not, and then waiting on the city and whatnot. So usually those are the only things out of our control, but everything else we try to do as quickly as possible.
So do you pull the permits, or do you have the homeowner pull the permits?
It all depends on the property. If it's usually most 3-family properties, the contractor has to pull the permit. But if it's a single family, we ask the homeowner to pull the permit because you pay less fees. It's still getting the same inspection. It's just how much you pay in the town.
No, and I forgot to ask Mr. Staples this, but I know you're referring to the 2 or 3K loan, which is the.
It's a construction.
So it would be similar to
right,
what
yes.
Hartford Building for
Yes.
this clarification.
Yes.
All right.
It just seems that the Harvard Building Fund is more lenient
Yes.
than with the
Yeah,
2
they
or
are.
3.
They are.
Yeah.
That's really good.
This was very good.
Yeah.
Anybody have any more questions? So now I'm gonna introduce the man that asked the most questions tonight.
Sorry, guys. I'm learning too. Oh, yeah, go ahead.
You got all the numbers and stuff,
Yeah,
right?
definitely.
All right. Jeremiah, he's from AAA. what he's gonna, obviously in this process, it's a little bit different because you're talking about properties that needs work and is vacant and all that stuff.
Yeah, it's a little bit, as Fabian said,
So-
it's a little bit different. My name is Jeremiah, I work at the Manchester AAA office. What I do is, I come across these, I used to come across them a lot more where I used to work, but I do come across these where it's an older home, people are trying to do the flip thing, and then all of a sudden they realize they need insurance, which they do need. The standard homeowners policy does not work for a situation like this. You just would need to have what they call a vacant dwelling policy. A lot of companies do not offer this insurance. You have to go through what they call a specialty lines insurance that will cover that. What I typically do in cases like this is I will write the policy initially and it's a little bit more pricier, for whatever the building purchase price is, and then I also have to insure for what you're going to be putting into it as far as labor, because we have to protect that as well. You don't want to have a situation where you have lumber, copper, all this stuff at the property and it gets stolen. You want to have that covered as well. Some policies will quote it as what they call an actual cash value, so not the full replacement cost of the home. They'll just do it for a portion of what it would cost they basically pay out a portion of what you purchase. So we'll just start off, let's say you have 100K, they cover, in some cases with ACV, up to 80% of that. So we're looking at $80,000. So be mindful of that if you're doing ACV policy. There are, raise too much.
Everybody got a number and stuff.
Alright. So 100,000, they'll do 80% of that, so you're looking at 80 grand. So they'll cover that. But depending on how much you're looking to purchase the home and how much you want to protect it, I can adjust these numbers. I have no problem giving you a little bit more based on what you think you're going to do. The rental cost, you need to let me know. So if you're going to put 30, let me know you're putting 30 as far as materials, and that's what your contractor can tell you, and you should know that at that point. It's pretty simple after that, and if you decide to hold on to the home, let me know that you've done that so we can cancel that old policy, because those policies, depending on the company you go with, some of them are short rate, so you don't get a refund back in some cases, depending on the timing. In some cases, you would get a full refund, but again, it depends on the policy and the type of situation that we're involved in. And then I could convert it to, once you get it up and running, you sell it, you rent it, whatever. At that point, just let me know, we can switch it to a regular policy. And then you have, structural coverages and whatnot, and it just insures it much more properly. That's pretty much it. I don't have all this cool stuff like Mr. Staples had, and that's pretty much it. And just protect. Yes.
So, if you're doing a flip, I know that you gotta do the big house, all that.
Mhm.
But what if it's a 203K? Do you still have to have that same policy, or can you get a regular one?
So we could do a regular one, depending on how much work is being done. If it's minimal cosmetic, where we're, paint, maybe a little bit of siding or something, not a big deal, let me know. If there's a problem, I can, if you're gonna, for instance, there was a situation, I dealt with this, she didn't even tell me till the inspector went there, I got photos in an email, they were gonna cancel the policy, and the girl sent me photos, they literally did it within 3 weeks, it was done. So, that is cool, we can take care of that. But if it's something where you're gonna be gutting this house to the studs, at that point, I wouldn't waste my time or your time doing an HO3 policy. We would do a vacant. But if it's very short, minimal, we can maybe get away with doing a regular homeowners policy. So that's what we have out there. And yeah, that's pretty much it. They are a little bit pricier than the regular policy.
And Jeremiah has some cards too.
Yeah, I have some.
You wanna talk a little bit about
Oh yeah.
replacement costs versus?
Okay.
Because I think that's a big misunderstanding.
Correct.
With people.
So with the ACV, and again, you have to have your agent explain this to you. And every company is a little bit different, so I don't want to quote everyone, but the company I deal with will basically do an ACV policy, and they'll do, as I said, I just use 100,000, but they'll only cover up to 80% of that property. So if you go in thinking you're gonna get that full $100,000 back, if it burned down completely, you won't. So they're gonna come in and say, okay, you rated it for $100,000 with depreciation. We think it's only worth 65 or 75. That's all you're gonna get. So be mindful of that when you are purchasing an ACV policy. I personally, the only time I think it makes sense due to the timing and how short you're probably gonna have the policy, the likelihood of something happening is it's a little bit slimmer due to the time frame. You could get away with the ACV, but be mindful of that when you are going in, because you can do a full replacement cost vacant policy, but it's gonna cost you more money. In that case, I mean, I've seen some of the pricing on even just the regular vacant. You're looking at anywhere from $1,000 to $2,000 for the year. Let's hope you don't, and I hope that you don't stay in it for a year. But there's times where that happens because of the situation. So you have to be mindful and ask your agent, like, what is this actually covering? Because each company is a little bit different when it comes to vacants. So there's some companies that will do it for full replacement cost, but it will just cost you more money. And you're right, people have that misconception that I did it for 120, so I'm getting 120 back. In some cases, depending on the condition of the home, whatever happened to the house, they'll give you up to that 80% of whatever you had the house covered for. So you gotta be mindful of that. And do things to protect the home. I mean, I know it's a construction site, but make sure you have things locked up, because that does happen when someone robs the place and the $10,000 of lumber or whatever you bought is gone. And then now you gotta put in a claim, and that just makes your process even harder. You know, you're trying to make money and now you're spending even more money. So just be mindful of these things with that. Do I have any other questions? I'm a smaller piece in this, but it's something that's very important to have that investment protected for that while it's in that condition.
Alright, so just in case there's anybody in here that would like to invest and the credit score is not at the level, you could always see these ladies afterwards. They do credit repair. They'll be able to boost your credit a bit, and you'll be able to go see Mr. Staples. So, UCES. So in conclusion, I said the process of buying and flipping a home or buying a whole in a home is not as simple as you might see on HGTV or whatever channel is that's your favorite at home. There's a few more pieces to the puzzle, and it's not always a smooth journey. Sometimes you get lucky. But my goal with this seminar was to put all the pieces together where we will make that process a little bit easier. All right, kind of point you in the right direction. So I thank everybody for showing up tonight, and I hope that it was good. Hope there was something that you learned new that you probably didn't see on YouTube. So thank you. And there's a lot of food still left over. I don't think anybody touched the cookies, so feel free to help yourself. The pizza's probably cold, but I got a microwave over there. If you guys want to warm it up. No questions. Everybody's all set.
First of all,
Good.
I got one of my cards too. You have a property now?
no, I'm just starting to get with you. That's me and my brother. I'm telling